The Federal Reserve just releasing its Beige Book economic report moments ago. It says the economy expanded at a modest pace through August. Now, the survey also says that the majority of businesses remain optimistic despite the U.S.-China trade war. Joining us is Larry Shover. He is the Chief Investment Officer at Efficient Advisors. Larry, what stood out to you?
Well, to me, it's like a moderate pace. I mean, the Fed is right. The Beige Book says that the economy has expanded, but a lot of it is lagging. It's looking behind. Right now, there seems to be a divergence between business sentiment, and that's shown through capital expenditures and the consumer. I mean, the consumer really has carried the day. And if that starts to waver a little bit, that could spell trouble, and I could see a technical recession. But so far, it's been good. It's been status quo, and the consumer is as robust as ever.
There's been a lot made about the weakness we've seen in the manufacturing sector. The data we got this week coming out with the U.S. Manufacturing contracting for the first time in 3 years. How big of a concern is that for you?
Well, one number doesn't make a trend. However, it is concerning because we continue to see that with manufacturing surveys around the country and around the globe. And I think what's happening is like the trade tensions that we've had going on for so long are starting to work their way into the the underneath part of the market. Is starting to undercut things like manufacturing, and we're seeing that with capital expenditures.
It's interesting to see the reaction or the sentiment coming through from this survey in terms of the impact the U.S.-China trade war has had. Looking at a majority of business owners saying they remain optimistic about the near-term outlook. And then, we did get that survey last week from the U.S.-China Business Council saying 81% of companies said that they had been affected as a result of the tariffs. So it seems to be a mixed picture. How do you see the impact so far?
Yeah, well, I see the impact in industrial production, capital expenditures, and not so much surveys. And you're right, even the last Empire Manufacturing Survey and the Philly Fed that came out like 3 or 4 weeks ago, both of them were quite positive and really caught the market off guard. But I think the truth is in the numbers of what businesses are spending. Are we going to see wages go up? We'll see that on Friday. Those are the kind of things we need to look at. We need to look at them every month and not just one number like yesterday's and think, oh, wow, this is terrible. It may very well be. I just think this trade tension situation is not going to get resolved in a day, a week, a month. And I think a lot of damage has already been done.
There is the broader question about what this all means for the Fed moving forward to the next meeting. There's been so much focus about these rate cuts, given that President Trump has constantly tweeted about it, saying that, look, they are the reason why there's so much volatility in the markets, why there is decelerating growth. I wonder how much what you think is the limit of the Fed. In other words, can the Fed, the Fed may be able to cut rates, but does that need to be matched with some kind of stimulus on the fiscal side of things in order to really see a boost?
Yeah, that's a great question, because I think that's the next generation of Federal Reserve stimulus is fiscal cutting and fiscal programs. Fully recognizing that cutting rates in and of itself isn't going to be the answer. It's done a lot of good since 2010, but at this point, who knows? And I think it's going to be other things, tax measures, and other areas of the economy that the president can have a handle on to help with the economy and not just cutting rates.
And we did get some interesting comments today from former Fed Chair Alan Greenspan talking about the volatility in the markets, where he said that the next recession could be tied to stock market performance, that people shouldn't underestimate the wealth effect on the economy. Do you agree with that comment?
Partially agree with the comment. It's really according to whether we have a recession, a technical recession, or a slowdown. I mean, there's a huge divergence between the consumer. Right now, consumer debt just hit an all-time high of $13.86 trillion. Last time we were up anywhere close to that was the third quarter of 2008. Now it's more about student loans and autos. that could really stymie the consumer going forward. But that said, the wealth effect is something that's hard to fathom and hard to really predict. But yeah, I partially agree with the fact that we could have a recession, even a technical recession, and the stock market's not going to collapse because of it.
And Larry, finally, it seems like we're kind of bouncing around on any given headline each day, whether it is on the trade front, whether it's on Brexit, whether we're watching where the Treasury yields are headed. What worries you the most as you look ahead to the next 6 months, the next 12 months?
Yeah, what worries me the most is the consumer. That's something I'm laser focused on, and the fact that we're at $13.86 trillion in debt with mainly auto loans and student loans, not as much mortgages because mortgage standards have been heightened so much. But if the consumer begins to waver in a meaningful way for 2 or 3 months in a row, I think that really could lower PCE by almost 1%, which would really affect real GDP and would be wavering on either a slowdown or a real recession.
Okay, Larry, good to talk to you today. Larry Shover, appreciate your time.
Thank you.